Hey! Hi guys, and welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto trading. I'm your host, Marcel Pechman, veteran stock markets and derivatives trader, analyst at Cointelegraph. Today's show will start by explaining what are sovereign wealth funds, why they exist, and how they are relevant to the markets. Well, for starters, those are mutual funds, so investment vehicles just like those managed by Fidelity and Vanguard, except they're either funded or sponsored by the government's own money. Those funds usually come from a trade surplus and differ from the assets held by the central bank or the government employee pension funds. Firstly, the sovereign wealth funds aims higher returns, but more importantly, they are not designed cover expenses. Sure, some of them can be used for stabilization mechanism, including the local currency or pension reserves, but they do not have to remain liquid for the next couple of years, nor require annual gains above certain indicator, as opposed to traditional pension funds. So when I'm talking about remaining liquid, I'm talking about market liquidity, when an asset can be converted to cash. So a high liquidity asset, such as bonds or stocks, mean it can be sold without a huge impact between 1 or 2 days, maybe even on the present day, and convert to cash. Those are liquid assets. Illiquid assets, on the other hand, such as real estate investments, can take 6 months or a year to be sold. So most mutual funds focus on liquid investments, whereas the sovereign wealth funds can invest in whatever they want, including illiquid investments. So basically, the sovereign fund manager can either pick higher risk assets or illiquid long-term investments, as long as there is an opportunity for profit. That's very different, let's say, on how the US Treasury handles the government money, as they follow a strict budget imposed by legislation. The largest sovereign wealth funds amass royalties either from oil exploration, but others benefit from privatizations, balance of payment surpluses, or resource exports. Let's have a look at the ranking of the biggest global sovereign funds. The number one is from Norway. It holds $1.4 trillion, followed by CIC in China, $1.35 trillion, Safe China's as well, $1 trillion. Then you have Abu Dhabi with almost $1 trillion as well, Kuwait, Saudi Arabia, GIC from Singapore, Qatar, Dubai again, Temasek for Singapore. So you have the list, and there's the AUM, so it's the asset under management in US dollar billions. So the top 100 sovereign funds hold an aggregate $11 trillion. But more importantly, notice that apart from Norway, most hold between 25 and 50% on alternative assets. So 25, 25, 22, 29, 37, 25, 40. So that's alternative assets that I'm showing you this right column, meaning they're not allocating into the world's largest stock markets or typical bonds from governments and global companies. In theory, there's nothing stopping those sovereign funds to acquire Bitcoin, for example, although investing in a new asset class usually means trouble for the fund manager and the remaining support areas, such as legal, compliance, risk management, and operational. For starters, they need to explain what was the price basis used to analyze whether the orders were fairly executed. Then, the custody solution provider needs to be examined and approved. From a regulatory perspective, the fund's own regulation might be needed to change to accommodate a new asset class, and so on. But ultimately, if Bitcoin's price increases by 20 times and the fund manager doesn't have any, odds are this person won't be fired or grilled by the committee. No one expected the sovereign fund to invest in Bitcoin, given that the asset is not part of any relevant indicator, such as the Bloomberg Commodities Index or the US Dollar Index, the DXY. So for now, it's the classic chicken and egg problem. But as soon as Bitcoin becomes more commonplace, likely due to the spot ETF approval, then the sovereign fund managers will no longer have an excuse to avoid some exposure. That shows how relevant the ETF approval is, not by just offering a new vehicle to invest, but by pushing the boundaries for Bitcoin to enter indexes and other industries that are simply disregarding it, despite currently having the means to invest without the ETF. Now let's move to the US Federal Reserve. After our dear President Bullard say that will no longer serve the institution starting next month. St. Louis Fed President Bullard says he's stepping down in August. That's our guy here, Bullard, from the Fed St. Louis. It's been both a privilege and an honor to be part of the St. Louis Fed for the last 33 years, including serving as the president for the last 15 years, Bullard said in a statement. Okay, so the Federal Reserve is the central bank of the United States. It is responsible for setting the monetary policy, supervising and regulating banks and other financial institutions. It differs from the remaining counterparties such as the European Central Bank, the ECB, and China's POBC, because the Fed is kinda decentralized, with 12 regional banks located throughout the United States. But the Federal Reserve is controlled by a board of governors, which is appointed by the President of the United States and confirmed by the Senate. So they're kinda under Biden's administration, even though the legal entity is not. Now, Bullard is not a current voting member of the FOMC meetings, which decide on the interest rates, but the St. Louis Fed stands out from the other 11 regional banks due to its state-of-the-art research and data. For instance, if you search for the M2, the amount of money in circulation, you're gonna be redirected to St. Louis Federal Reserve data. Let me show you. There we go. Economic research of the St. Louis Fed, and you get the M2 data, which is one of the most important indicators of the amount of money circulated in the United States. Back in January 2021, the Fed St. Louis decided it was worthy to track the price of a dozen eggs in Satoshis. Yes, in Bitcoins. So the higher the chart, the costlier it is for Bitcoin holders to acquire eggs. It made sense for them because egg was considered something relatively stable, close to $1.6, $1.7 per dozen for the past 20 years. Their intention, it seems, was to show how volatile Bitcoin was. Well, if only they could know. The price of eggs entered the crazy bull run late 2022, soaring to near $5 per dozen, and subsequently declining to $2.2 in the next 6 months. But, more importantly, at the current prices, we only need 7,000 Satoshis to buy a dozen eggs. That compares to 14.6 thousand Satoshis from 3 years ago, back in July 2020, and 53,000 Satoshis back in July 2017, so 6 years ago. So what the Fed is showing is that holding Bitcoin is a good investment. Even though eggs price rallied, you still have to spend less Satoshis year after year to buy a dozen of eggs. So thank you, Bullard and the Fed St. Louis. Keep on doing research and creating new ways to entertain us. That's it for today. I hope you guys enjoyed the show. Make sure to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. See you!